When you look at a stock chart like this one for Amazon, the movement seems completely random. It is a dense, jagged wall of up and down lines that can feel overwhelming if you haven't spent years studying the markets. These movements are actually a record of a massive, ongoing tug-of-war. On one side of the rope, you have the buyers, the green bulls. On the other side, you have the sellers, the red bears. When buyers pull harder, they drag the rope to their side and the price goes up. When the sellers gain the advantage, they pull the rope back and the price drops. Sometimes both sides are so evenly matched that they reach a stalemate. The price swings get smaller and smaller, like a spring being squeezed into a tight space. We call this consolidation. This stalemate creates a recognizable geometric shape, a triangle. Spotting that triangle reveals the hidden structure in what once looked like chaotic noise. There are two main versions of this battleground, and they function like mirror opposites. In an ascending triangle, the sellers have built a flat brick wall at the top, called resistance. But notice the bottom line. Buyers are stepping in at higher and higher prices each time. They are aggressively pushing up against that ceiling. A descending triangle is the reverse. Buyers are holding a flat floor of support, but the sellers are pushing lower and lower from the top, squashing the price range. Eventually, the space inside these lines runs out. The pressure reaches a breaking point until the rope finally snaps. This is the breakout, a sudden, sharp move where one side finally wins the struggle. By identifying which triangle is forming, we can see which team is building more momentum. It gives us a statistical clue about which way the price might jump before the explosion actually happens. A common mistake is rushing to join the winning team the very second the price touches the boundary line. You see a tiny move up, jump in, and then the price immediately hooks back inside the triangle. This is a false breakout. The market briefly faked a move to the top before reversing and plunging in the opposite direction, catching everyone who acted on impulse. To avoid this trap, professionals wait for confirmation. Most charts are made of vertical bars called candlesticks, which show price movement over a set block of time, like a day. You wait for that bar to finish forming and close entirely outside the triangle. You also look for a spike in trading volume. High volume acts as proof that the rest of the market is joining the move, rather than just a few people causing a temporary blip. Confirmation is the discipline that separates calculating traders from gamblers. It provides a level of certainty before you ever commit your money. Even with a perfect triangle and confirmed volume, the market can be unpredictable. Sometimes the winning team simply loses its grip and the trade fails. This is why we use a stop loss. It is an automated safety net. You tell your trading platform that if the price reverses and hits this red line, it should sell your position immediately to prevent a small loss from becoming a big one. The goal of risk management isn't to be right every single time. It is to ensure that when you are wrong, the damage to your account is as small as possible. We see these concepts clearly on this real chart. Buyers build a rising floor, while sellers defend a flat ceiling at 810. Look at the specific candlestick breaking through. Because buyers held that floor, the resulting move up was powerful. Once you understand how to spot these periods of consolidation and wait for confirmation, the market starts to reveal its internal logic. You can stop guessing and make trades based on the real behavior of buyers and sellers.